All right, what's up, everyone? So I was trying to get through a lot of companies in the last video, but I only focused on Rubric, and I'm glad it worked out that way, even though I wasn't planning that, because it's good to just go through a little bit more in depth on one company. But for this video, I'm gonna do the 10 companies in the Slack that have that I didn't get to last week or yesterday. Okay, it's been a long week. So this video, I'm gonna try not to go too deep on any one company. So there's gonna be plenty of questions that are open, but I'm gonna just kind of go through and really try to get through these. So the first one is Reddit, and this is of course the famous social media platform. And I mean, it's a pretty good business, right? They been accelerating really nicely actually. And then IPO costs right there. Free cash flow is improving, and they've got a rock solid balance sheet now. So at first glance, I'd be like, yeah, this is definitely interesting. Let's see. I think I've added them to the database already. So we'll to on under the covers a little bit. So yeah, revenue has accelerated really nicely, but you can see that it decelerates. They have really easy comps here. And if I'm not mistaken, a chunk of this is actually due to the data licensing deal that they got. So we can check the 10Q and get some more information. So on this quarter in particular, we see a good jump up. So it's like, why did that happen? If we go to management discussion, if we find the revenue page right here, so you can see that year-over-year growth in ARPU is 8%, and year-over-year growth in weekly active user. That's a pretty big acceleration in weekly active users. That's interesting. Wait, what did it say here? During the 3 months, we deployed further advances in our process to use to identify and address activity by users and visitors, including web crawlers and scrapers. As we identify automated agents, we remove them. Okay, that's good. So weekly active users are actually growing really nicely. Okay. Revenue growth primarily increase in advertising revenue driven by an increase in impressions delivered offset by a decrease. Other revenues increased as a result of data licensing. Okay, so if we look for data licensing, how much actually was that? I forget. I even tweeted about this, I think, but forget off the top of my head. Okay, yeah, so it looks like it's mostly weekly active user growth. Yeah, it grew 37%. Why did weekly active users grow so much? Logged in versus logged out. So logged in is slower. It's actually US users. I mean, both kind of accelerated. Driven primarily by traction in our growth strategies, primarily from product enhancements and continued momentum from third-party search engine and algorithm changes. So it looks like their SEO is just improving. So that's pretty good that they're getting that traction. I definitely have this on the watch list. It's an interesting company. I mean, it's crazy to me that they are losing money though. I mean, if you've ever used Reddit, it's a very simple site. So the fact that they're just barely at free cash flow, we're not even, after next quarter, they'll be cash flow break even on a trailing 12 months basis. But I would dig in more to the acceleration. Like, that's a pretty marked acceleration. And what's next quarter? Can it continue? Probably not. What the transcript says. Is there any acceleration? Oh yeah, 20 million of data licensing. So without that, what would that be? 37. It's still a nice acceleration. There's nothing wrong with that. And then next quarter we got 39%. So it doesn't, it looks like the acceleration is gonna stop, and then it'll probably decel into the rest of the year. But yeah, I mean, there's obviously a lot of competition, but Reddit is a unique niche for sure. And then they're trying to do these data and licensing agreements. So, I mean, here's the thing with all these companies is they're going to be interesting. It's not like an easy pass. But my main questions here would try to understand more granularly the acceleration, and then try to understand. I would track the weekly active users and the ARPU metrics to kind of see like how many weekly active users they could get if you look at different social media platforms, and what's a reasonable ARPU to try to get like a total value that I think the company could get in the future, and then slap the multiple and margins on it. So it's definitely interesting. I don't think the valuation is like absurd. Well, 10 times forward sales. It's pretty high for this. So I'd probably be on the sidelines for now, but definitely keep it on the watch list. I also think the CEO changes in and out are kind of weird. So yeah, that's Reddit, first one. Second one is Alarum. I won't go too in depth because I've gone really in depth with premium subscribers. But what I've noticed is that for these next three companies, Alarum, Aspen Aerogels, and App11, all starting with A, and they all have a smaller segment of the business that has become a bigger segment that's growing way faster than the core business. Similar to Rubrik, and it's just interesting how the market seems to miss these companies time and time again, because you have to dig just a little bit deeper. You can't just screen for these types of opportunities. So Alarum, I mean, you look at the press release, growing 47%. Oh, that's really, pretty solid. But then the subsidiary that now makes up pretty much 100% of the revenue is growing 139% with a 66% expansion rate. So, I mean, if you really dive in, you can see with Alarum that so they do, let's see here. They do the expansion rate based on the trailing 12 months revenue. So trailing 12-month revenue is actually 154%, but it's sort of decelerating if you look at the quarter over quarter trailing 12 months. So that's not amazing. But if you look at this, we know that the expansion rate is 66%. So existing customers get you to almost 17. So the expansion is essentially like 7 million of revenue, and then new customers are like 9 million. So it's actually good that they're bringing in a lot of new customers. So more revenue comes in from new customers than the expansion of existing customers. Still, the vast majority comes from like 17 out of 26. 35% comes strictly from new customers. But it's good. The CEO said that customer count has doubled year over year, so nothing to complain about. I think they can do 15 million in free cash flow this year. So on a $300 million market cap, 20 times forward is not absurd, even though the stock has quadrupled since our first purchase price, more than maybe quintupled since our first purchase price in the fund and doubled since we bought it with Investing City. So that's all I'll say on ALAR. I've said a lot already. Aspen Aerogels is a really interesting company. So if you check out the press release, boom, same thing. You can see that thermal barriers is growing insanely, 459%. And then the industrial piece of their business is down year over year. So thermal barriers is on fire. And the reason why I haven't invested I mean, this is serious acceleration, 17 to 400%. The reason I haven't invested in Aspen is because they have a lot of customer concentration with GM, specific electric. So if we look at the concentration here, you can see that GM makes up for the year over, with these over 60% of revenue. A substantial amount of our expected sales in the EV market are expected to be a single customer. So it's basically the growth is driven by the pyro business. So these are these thermal, it's called pyrothin, a thermal barrier that essentially goes around the battery of an electric vehicle. And GM just really likes this product. And since they're ramping up and filling the dealership channel, this is just getting sold like insanely. So, I mean, that's a huge, okay, here we go. Substantial amount for the years. Our top 10 customers is 80%. GM was actually 41%, and distribution international. Oh, so this is accounts receivable, 60%. So GM actually makes up 41%. It's actually a little bit lower than I thought it would be. So that's good. But two customers make up 64% of revenue in the latest quarter. One customer, 64% of accounts receivable. So we know that's GM and distribution international. So yeah, it's probably in the ballpark of about 50% of the business is GM. Mind you, though, that's pretty much so. Okay, let's say 50% of revenue is from GM in this latest quarter. So of 95 million, we have call it 47 million from GM, and I do Pyrothin 65. So roughly over 70% of Pyrothin is from GM, and this is the main driver of the business. So it's really like over 70%. So I would just stay away from it. And I've missed out hugely because they've just been crushing it. So you really have to understand GM's electric vehicle strategy and see what the sell-through is. But maybe all of that doesn't matter. I'm just being, a bummer because they're going to 200 million next year and they could get to 500 million in not very long. So maybe it just doesn't matter at all. And the stock is, if they get 500 million and 5 times sales, that's still a decent chunk of upside. I mean, I started looking at this when it was like $10 a share and only 384 million. So that was a much different risk reward. But I've just got burned in the past with big customer concentration. I mean, stuff like air systems, and I don't know. Sometimes it might make sense to just size it really small and then see where it goes. But that's kind of my thinking. I think that's the big question that investors have to answer. Okay, moving on to AppLovin. I really like AppLovin. I think they are just a really interesting company. Once again, big acceleration. And once again, like I said at the beginning of going through these 3 A's, it's because they have a hidden piece of the business. The software platform is just taking off while their apps business is sort of just steady state. And AppLovin is extremely profitable. I mean, I have actually owned them, full disclosure, in the fund somewhat recently. So I basically, I think this is a really interesting company, but where I get a little bit nervous is the reliance on the Apple ecosystem. So I would love to see them really start to branch out more outside of mobile gaming. And because right now, the vast majority of the business is mobile gaming, and their Axon 2.0 platform is just, I mean, this is crazy, right? 91% growth, 70% adjusted EBITDA margins. So that's some serious growth. And the valuation is pretty cheap. So I actually really like App 11. It's it's hard to kind of dissect the reliance on Apple. And there was like the little bit of FUD a couple weeks ago with the Apple ecosystem, and they changed some things with privacy. I just think Apple's going to go more and more towards the direction of privacy, and App 11 will have a headwind with that. I think they'll probably be fine as they're branching out beyond mobile gaming and they getting into connected TV. I would definitely buy this over the trade desk personally. I think the valuation is just really amazing. But I just some companies you just can't quite get comfortable with, and I feel like that's App 11. But I'm keeping an open mind. It's high on the watch list. It's really high if I take off the diversification with Apple. Like if you take that out of the equation, it's a stock that could be bought within the system. But I mean, I really like the numbers. It's very profitable. The two things that go against it too is it has a ton of debt, 3 billion net debt, and then a ton of goodwill because they did the MoPub acquisition and all of that. So I I don't know. I really like the company. I don't want to say anything bad about it, but just personally, it's hard for me to get comfortable for some reason. And I can obviously change my mind tomorrow on that, but that's at least where I stand right now. Okay, next one is Next Tracker. Well, that's a coincidence. Next is next. Stock has sold off a bit. Another acceleration. So these are some great suggestions by folks. Some more acceleration, and those are beautiful margins. Big free cash flow, strong balance sheet, just a little bit of goodwill. But this would definitely be something that it would perk my interest. So it's already in the system. We see that nice acceleration, pretty easy comps. They guided to 17%, so we'll see some slowdown. The gross margins have increased a lot, and it looks like there's some seasonality here. But I think one thing to understand is the economic credits that they get in the business. So let's see. How much of that gross margin increase is due to accounting? Because that's a pretty big increase. Let's see what they got going here. I would like to understand the cost of revenue, what goes into that. Here we go. The IRA, Inflation Reduction Act. So the 45X credit, which was established as a part of the IRA, is a per unit tax credit earned over time for each clean energy component domestically produced and sold by a manufacturer. We have executed agreements with certain suppliers to ramp up our U.S. manufacturing footprint. These suppliers produce 45X credit eligible parts. So here we go. This is what I'm looking for. During the fourth quarter, blah, 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 we recognize a cumulative reduction to cost of sales of 121 million related to 45X credit vendor rebates. So that was $121 million that was a boost. So what's this? 219. So yeah, gross margins organically are more like 30%. So then what is that? Versus 46. So 16% difference. So this is not a 30% EBIT margin business, I'll tell you that right now. A good chunk of this is from these credits. And then industrial Industrial solar is going really nicely right now. So there's a big trend. I wrote this huge report probably last year about solar, and there's definitely a huge trend, especially in the industrial space, because I mean it's fairly cheap. They've gotten the cost down so much. I don't know. I like Next Tracker. Stock is pretty reasonable. I think the guide is, if you believe that guide that it's conservative, it probably looks like a good deal. If you think that it's going to come in more like this, I think it's just fairly valued. I think that's kind of what it comes down to. And then following these 45x credits, I think margins, I don't know how long they're going to last. So that's another thing to look into. If you just search these, I'd have to look into all the details of the IRA with this, but it would be interesting to strip out all of the credits and see what the core margins. Okay, here we go. Oh wow! So it lasts till 2029. So it's actually not that bad. And I just think more competition will come in. I mean, basically, this product allows the solar panels to move with the sun, and if there's hail or snow, it like shakes them off. Doesn't honestly seem like that much of a moat. It seems more like a technology advantage. Maybe I'm just superficially understanding the business, but it seems if you strip out the credits, which maybe you shouldn't because they're going to last 5 years, but it just seems like fairly valued, not like insanely cheap. And then these become tougher comps towards the back half of the year. I mean, if you had a portfolio, maybe this is in it, but for super concentrated, I'd probably pass for now. It's definitely high on the watch list though. So once again, all these companies are pretty good. Okay, next one is Vicarious Surgical. Ticker is RBOT. So my good friend Jeff talked about this one. So it doesn't have revenue, so it'd be an immediate pass. But just reading up on this a little bit, it's super interesting. So it's founded 10 years ago, and they have a novel surgical approach that uses proprietary human-like surgical robots to virtually transport surgeons inside the patient to perform minimally invasive surgery. So that sounds like straight out of sci-fi. Um, so maybe it's one to just keep on the watch list, and as soon as they start commercializing, you may be late, but you decrease your risk a ton. I mean, they have 84 million. What's the balance sheet? That's the important thing with these types of companies. So 80 million of net cash. Burn rate was like 15 million. So they have a little bit more than a year to start commercializing, and then there's going to be a burn to ramp up. So they're definitely going to have to raise money, it would be in my estimation. So I wouldn't race out to buy this or anything. It could be more of a longer term, keep an eye on it, look out for some commercialization, some revenue, and then we can dive a little deeper. But right now, it just looks interesting, and keep it on the watch list. Okay, Shopify. So I love me some Shopify. Haven't owned it in a while, though. It's just, I don't know. I mean, revenue growth is stabilizing. They're now got profitable. Free cash flow looks great. It's 80 times free cash flow. Maybe 7 to 8 times forward revenue. So it's just never been cheap. But it shouldn't be because it's a really high quality business. So it's top 16 on the system. So top 2%. It's a really good company. I like the CEO. I mean, just look at that growth. Just look at all those numbers. Beautiful numbers. It's gone from 23 million in revenue to this year do 8.5 billion. Like that's just insane. What's the CAGR on that? So 13 years. 57% CAGR over 13 years. That is crazy. So I don't currently own it. I just think the valuation is a little bit high. So if you go to my quick model here, so even if it grows, even if it accelerates to 30%, right now it's going 23%. So that's even aggressive. So let's say it grows at 25% and they get, if you just wanted to be crazy, I mean, the thing with payments, the payments business is never going to be that high margin. But let's say you can get 30 times on 30%. So, I mean, 19%, that's actually not that bad. It depends on what you think the terminal margins should be here. If you think they're more like 25% and 25% growth, that takes it down a bit. But what are the free cash flow margins right now? So yeah, 13%, and then how much in stock-based comp do they have on $1 billion? Yeah, they don't have egregious stock-based comp, honestly. Pretty nice. So yeah, thanks for making me relook at this. I think 25% is probably a bit, like that's saying that they accelerate slightly and then keep that. 20% is probably more reasonable with 30% margins. So yeah, I mean, this moves them up actually in the system slightly. This is almost top 1%. So, I mean, there are certainly worse companies out there. 9 times forward sales. So yeah, it's a little bit higher than I thought. I think the question here is what's the future of e-commerce going to look like? Amazon just has such a big moat in the logistics. There was a time there where everyone was like, oh, maybe Shopify can compete with them. Now it's like, no, it's just more of not a niche, not an, but with really, large companies, Shopify Plus, they want like their own web presence and they're not going to just sell through Amazon. So then you have to understand how big of the $2 trillion e-commerce US market is that. It's kind of hard to break that up, but it's like, can Shopify be a $1 trillion company one day? You sort of have to think bigger like that, but I just don't think it's really cheap. So I'm not quite there yet. I like when you're in a 4 on the system. I like it in the 80s. So we're not quite there yet, but it's getting there. It's getting there. Yeah, so these are like all my software companies that seem to sit right in here that are just haven't quite got cheap enough. Duolingo, Shopify, Procore, and CrowdStrike. Just a little bit, just too expensive right now. So Tesla's the next. This is a really hard one to do because you have to click by the numbers. It's an auto sell, in my opinion. You can quote me on that. But if you look at these numbers right here. Growth is going negative, margins are super thin, free cash flow is lumpy, rock solid balance sheet though. So if you just looked at that, it's like, it's probably a stodgy company that, not much is going on. But then if you'd look at you can just pull this up. So 2 billion to 100, almost 100 billion. So from 2023 to 2013, that is 10 years, obviously. What's the CAGR on that? 47%. So, just huge growth. And this is a physical goods company. They had to build all these gigafactories. This isn't just Shopify, like infinitely scaling. So it's just all the more impressive. You either believe in Elon or you don't. You think he's a madman. I believe that full self-driving and Optimus will happen. It'll probably take a bit longer than we think, but just the optionality of this business is insane. And if you attribute no value to those options, I think that's also disingenuous because just look at his past track record. There's some probability of a huge future, and so I think valuing the options is important in this context. So this would be a hard one to just go through and all of that, but I mean, it's 700 billion. You could definitely make the case it's incredibly overvalued as a car manufacturer. But if you drink the Kool-Aid and you think, Robotaxi, Optimus, it's a $10 trillion valuation within 10 years is not completely out of the question. And I'm not saying that that would happen, but there's not many companies you could say that. It could go up 20x. So I think it's in the fund right now, it's smaller position than the Investing City portfolio, just valuation wise and stuff like that. I like to see a little bit more evidence, but yeah, that's Tesla. I could go on and on and on, but thanks, Jeff. Shop and Tesla are some. If you're a long-term investor, I think you've done really well with those. Okay, CAMT. I've looked at this briefly. I think it's something related to semiconductors. So once again, execution margins are pretty solid. It's pretty expensive on a trailing basis, but margins have come in. Okay. I mean, I know about this company. Let's see if we can pull up the 10K here. So it's international. It's a 20F. I don't even know where they're based out of. Israel. Nice. Okay. Yeah, so it's a semiconductor company. Looks like semi capital equipment. So a lot of this is just super in depth with inspection and metrology. I wonder who competitors are. Probably like KLA. Maybe. Okay. Onto. Yeah, KLA. Limited. It looks like they do smaller sort of niche. I'm saying niche weird. Niche. Niche. Okay, KLA. So, I mean, we definitely have to understand. This might be a hard one to do because just trying to understand what they do. But it's semi-cap. I'm sure there's some AI tailwind here. Okay, this is high bandwidth memory. This is the stuff that like SK Hynix and Micron are selling like crazy. Micron just said that they doubled sequentially in their data center solid state drives. Okay, so this is interesting. I'm pleased with record revenues, strong demand for high bandwidth, account for 60% of our business. Annual sales of in excess of 500 million. So I don't know if this is in the system yet. Is that just saying beyond 2024? I wonder what that specific milestone is. But even still, we got, call it 30% margins on 500 million, so 150. We have a $6 billion company. So still like 40 times EBIT in maybe 2 years. It's just kind of expensive. I mean, we have 15 times forward sales. I don't know if I'm current on this though. So maybe don't believe my numbers. Because the fiscal years I'm off. Let's see here. Yeah, I think I have them off. So we could add these. So it might be 500 more like in a year. So 40 times earnings next year. So that's actually not as bad as I thought. Okay, let's try to add this real quick. Okay, so bolded means that they've already happened. It's not a guided number. 40, 39, 17, 19. Yeah, free cash flow is not included here. It must be just because it's an Israeli company. Koyfin can't pull it or something. But if we just look at EBIT, let's just pull this over real quick. Okay, so margins have done really well. I mean, that's the thing with these companies. They're big fixed assets, but if you increase the utilization, it's like just cash cow. You look at all the semi-cap companies, ASML, KLA, Lam Research, Applied Materials. Okay, so what are we doing here? Is there any guide on this? Looking beyond 2024. That's all we did. Oh, here we go. 102 for second quarter. That's good to know. 102. So further acceleration. It's great. Yeah, I'm stale on this name. Jim, you have got some good ones. Okay. And then let's update our numbers here. So let's say it grows 35% over the next year. Yeah, 13 times forward sales. So it's definitely expensive, but more like 40 times on 30% margins. Where is this in here? So, yeah, I mean, I don't know what it can grow over the next 5 years. Maybe 25%. Maybe terminal margins are more like that. So, yeah, it's actually interesting. Pops up the system top 8% or so. I just think it's a little expensive, but interesting nonetheless. Stock looks like it's at all-time highs. Interesting to dig in. I mean, I like these companies. They can just be so profitable. A lot of competition though. I don't think Onto is doing that well. So yeah, there's some special. I mean, it's just picks and shovels, right? Seems like an interesting company. I'll keep digging in on it, but I wouldn't buy it just because it seems a little bit expensive. Let's see the chart here. Wow, that is pretty. Stock's already up 5x in like the past year. But that's awesome. Look at that long-term chart. Sheesh. I don't know who the CEO. Dang, if this guy founded the company, he'd be a goat. Before that, served as active chairman, CEO from 1998. Who founded this company? Looks like these guys have just been around the block. I'd like to look into past of the company a bit more, try to understand how it happened. I don't recognize any of these names. So that would be an important thing to do, I think. But I'll put on my list. It's a good one to keep an eye out for. So we've already gone 40 minutes. At least we've gotten to 9 companies. This is the last one. JFrog. I think this is an interesting company for sure. Revenue growth has really stabilized. They're still gap negative, but free cash flow is pretty good. So call it like 40 times free cash flow on a trailing basis. But stock-based comp eats all of that. So, I mean, at this point, I'm getting kind of impatient with software companies that are negative on a free cash flow after stock-based comp basis. It's like, but I mean, really nice growth. They just not super profitable. It's just big stock-based comp. So I would pass just because of that. But valuation has come down quite a bit over the last 3.5 years. The stock has been cut in half. So 27 times forward sales to 8 times. So they have this cloud business. I need to update that. I think this would be important to look at what this is growing at. But it doesn't seem like egregiously cheap either at 8 times forward sales. So maybe that's because the cloud business is growing nicely. Yeah, I mean, it's nothing to write home about. It doesn't seem super exciting, but I know the management team is really solid there, and they're just kind of trucking along. Another Israeli company, if I'm not mistaken. It's just amazing how many really innovative companies are out there. So, yeah, that's the 10 companies. Thanks for including a company, and I really enjoy this. So it's good to just always look at and refresh my opinions. So CAMT is probably the most interesting one out of all of those. Like, I mean, the only one I own currently is Alarum, and then I'd probably own App 11. Oh, sorry, I own Tesla too. And then App 11 is definitely, I keep going back and forth on that. It's kind of a love hate. And then CAMT is probably the big watch list one that was new to me that I haven't looked at in a while. So thanks, Jim. And that's one I'll be digging on. So yeah, 43 minutes. We made it about the same time as one big old rubric video. So feel free to shoot any companies. And then when I get 10 again, maybe I'll do another video. But for now, have an amazing weekend. And thanks so much for watching.